This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are very pleased to welcome on with us Dave Zook with the Real Asset Investor. We're going to be diving into at least one interesting topic today. I know a lot of people have been seeing, at least where we live in Florida and across the nation, all these car washes popping up. Now, that's, one thing if people wanting to keep their car clean, but there also is money on the other side of this. So whenever you do see infrastructure and development, that means there has to be some type of corresponding investment and some type of money to be made, and that's what we want to dig into really with us here today. But before we get started into this, interesting topic that I'm interested to explore more on, kind of the economics and what this kind of asset class looks like, maybe give us a little bit of background about yourself, Dave, because one of the interesting things about anyone involved in real estate is that no one goes to college and gets their degree in developing, self-storage units and car washes. Most people kind of have an interesting career trajectory before getting to this point in what they're doing in real estate. And I always like to hear, kind of how people came to be with what they're doing. So Dave, tell us a little bit about yourself.
Well, first, Alex, thanks for having me on the show. Happy to be here. In terms of background, I have a background. Our family business is modular buildings. So I grew up in the modular building space and am still involved with my dad and my brothers in our family business. And so growing up in that business, in that space, I sort of, covered almost every aspect of that business as I was growing up, and eventually took an ownership position there, and also started in my 20s and 30s, founded a couple businesses. Some of them had to do with the modular building space, but really built up several businesses and got to the position where I was really making a lot of money, and I had to pay a lot of tax. And at the point I was paying $500,000 a year in tax, I just got tired of it, and I said, man, there's got to be a better way. And I had sort of made up my mind early on in my career that I was not going to be a real estate investor. I watched my dad self-manage some private, single-family homes, and I just quickly recognized that wasn't going to be me when I grow up. And so I went down the business route, got into a tax position, started digging, and realized that many people were using real estate, multifamily apartments, bonus depreciation, cost segregation. So I started learning that language, and that's why I got into the real estate space, was because I had a tax problem.
Yeah, that's one thing that real estate does offer is the ability to reduce taxable burdens quite a bit, especially if and the cool thing is you don't have to get too far into the weeds to really get a lot of advantage from it. At a high level, just writing off all of your expenses for an investment property is, a very straightforward thing to do. It's like, okay, I bought a box of nails. It's for an investment. I can write that off. Granted, there's record keeping and some, you can get definitely into the weeds when it comes to doing cost segs and accelerated depreciation and, 1031s and stuff like that. But, it's not something that you need a masterclass in offshore accounting to, accomplish a good deal of tax mitigation using real estate. So that's kind of interesting that you kind of, got your door, kind of opened into real estate by some of the awesome tax benefits that it does offer. So again, always interested to hear how people kind of, fall into this space, and glad to know that it could keep some more of the money in your pocket, because it's not about how much you make, it's how much you take home at the end of the day.
Well, that's right. And, real estate offers so much more than just the tax benefits, building wealth, cash flow streams, equity, all of that. But for me, I was desperate. I mean, I wanted to keep, like you said, I wanted to keep the money that I was earning. And many times, if you get to play in this bonus depreciation, cost segregation game, many a times when you invest in one of those larger assets, that can be your first year. That can be your biggest return in the first year, is when you save that 40% tax that you would otherwise send into the government. So I love it.
Yeah, absolutely. So let's kind of start digging into this. I know, and at least, and I've had some, some a little bit of exposure to the investment side of what the car wash industry is. But kind of let's start from the beginning of why have these started to become such a by the fact that they are multiplying and you're seeing more of them, has to be some type of attraction to investors and some type of infrastructure on the back end to these. So let's kind of get into the nuts and bolts of this. Why exactly are we seeing an increase in these things pop up? What do the economics of these things look like? And from your perspective, let's just kind of branch out from there.
Well, I think people are starting to recognize, much like they've started to recognize that self-storage can be a really good asset class during a recession and just really provide some stabilization in your portfolio. People have also started to recognize car washes for a number of different reasons. One, it has proven to be a pretty recession-resilient asset class. People are interested in that these days. The other thing is it's a very aggressive cash flow play. When you talk about a stabilized, well-run tunnel car wash where you can really crank out the volume, that's a cash cow. That's a real cash flow machine. The other thing too is it has some very unique tax benefit that a lot of people aren't familiar with. Car washes and gas stations are one of the only two commercial real estate asset classes that I know of where you can take the entire building and depreciate it just like it was a piece of equipment. So that gets really interesting. So you can take 100% bonus depreciation. You can take, of course, 80% of it now in the first year, not only on the equipment inside the building, but you can take the whole building and use that kind of depreciation. So, people are starting to recognize, number one, just the cash flow. These things are cash cows. And then, of course, some of the other aspects that I just mentioned. And in terms of institutional demand, it's on their radar. And it's very early in the game. They're coming to the game very early. I mean, we're talking second inning. And one of the problems for an institution, and we can talk about this later if you want, but one of the problems for an institution to get a real foothold in this space is it's so fragmented. Almost the entire car wash industry, a large majority of the car wash industry is owned by mom and pops. There are there are very few car wash portfolios that are 20, 30, 40, 50 car washes in a portfolio where an institution can come and write a 9-figure check and take a sizable position.
Yeah, absolutely. So definitely some stuff to unpack there, but maybe let's start at the very beginning. So with regard to this, we've kind of established why these things might be an attractive investment option for people. But when it comes to doing this, I'm assuming there's kind of, one of two main avenues that arrive when you first do this. It's either, kind of like, just like with anything in real estate, do you acquire and reposition or do you build from the ground up? So are most of the plays that you're seeing or you're involved in, are they kind of a new construction ground up development, or is it a buy, reposition, go from the C class to the B class or the B class to the A class, quote, property in this segment? So which one are you mainly focusing on, or is it all market dependent? Let's kind of start at the very beginning of, saying, hey, we're buying a car wash or are we building a car wash?
So the answer to the question is yes. We have purchased 8 operating car washes, and we're on pace to build between 80 and 100 more. So we've got 70 or 80 lots in the pipeline, and in some form of contract or LOI, or we're going through the entitlement process. We actually got 10 in full-blown construction mode right now. Pools coming out of the ground and roofs going on, and so we're only Tommy's Express. We're not going out and buying mom and pop operators and a bunch of different brands and trying to consolidate. We're Tommy's Express Car Wash, and we're that's a kind of the leading brand right now in terms of technology and efficiency, and they hold a lot of their own patents, and when you go to any major car wash show in the industry, Tommy's will be sort of the gold standard, and so we're we got a lot of building going on right now. So we're primarily focused on building car washes, bringing them out of the ground, but we are also in the market for, a seller, a small mom and pop operation that has 2 or 3 car washes that wants to unload and go do something else, go retire or whatever.
Yeah, absolutely. And with those, so do you see it being more of a, the build up from the ground side, it's that makes sense. You have a brand, is that a franchise model or a licensing model, or is that like the IP that you own for the Tommies? Is that just one that you're building and developing yourselves, or is that kind of a franchise license agreement?
It's a franchise model, and we
Okay.
we should be by the end of the year one of the top 2 franchisees in the country, and we expect to by the end of next year be the top franchisee in the entire organization.
So you're so and the funny thing is I just did a interview with a guy about doing franchise agreements. So are y'all issuing the franchise agreements, or you are trying to become the largest like operator of this particular franchise?
We are the franchisee, so we're the operator of, we're
Yeah.
actually there's we're teaming up with Tommy's
Okay,
Express, who
gotcha.
is the franchisor.
Okay, gotcha. Yeah, it's a new industry to me, and the funny thing is, I've had 2 different people on the podcast about doing franchise investments. So I've learned a lot in a short amount of time, but the terminology is still a little bit new to me for the licensing and franchising, franchisee versus franchisor kind of thing. So again, let's go back a little bit. So we have that particular play now. When it comes to the acquisition of the individual businesses. Is that something that is just done kind of on a point-to-point basis, or is that a reposition to become a under that franchise flag? Are you just trying to get more of a footprint, or are those have their own kind of carve-out niche where maybe it's better to keep them as a standalone? How do those kind of play into the portfolio that you're trying to build with this?
So the answer again is yes. We've bought Tommy's. We bought stabilized Tommy's car washes that were branded Tommy's, and then we bought some non-branded Tommy's, which doesn't exist anymore. They don't do that anymore. But years and years ago, they used to, basically sell the building, the package, everything. You could start up Alex's car wash if you wanted to, and it could be an entire Tommy's, all the equipment, building, and everything. They don't do that anymore, but there are still some of those out there, and we just bought one within the last 12 months. We just bought one in Salt Lake City that was like that, and then we brought it back into the fold. Like we put the Tommy's franchise brand on it again. So we feel
Okay.
like there's a lot of advantages to being inside the franchise model, and it's unlike most franchises that are getting a franchise fee in the double digits. Here it cost us low single digits to be a franchisee, and we feel like the value far outstrips the cost to do so.
Okay, great. So let's look at the one where the model again, where you're saying you're focusing a lot of your capital and efforts, which is, real estate acquisition, development into a new car wash. Now, obviously, there's a lot of, kind of tax benefits to doing that and having some of that vertical integration of the acquisition to the building to the franchise tag to the operations of it. Let's kind of talk about that. What are some of the big advantages that you see of going that direction? Because obviously, that's kind of where you seem to be focusing a lot of things. Is it mainly is the benefits hung on taxes? Is it hung on revenues? What do you see as the main benefit to kind of focusing on that trajectory for investing into car washes?
So I think it's primarily around value, because we can go out in the market and we can buy a stabilized car wash for $10, $12 million, and that may be okay. But at the same time, we can go and build that same car wash for $7.5 to $8 million, including the real estate. So, there could be a real advantage for going into a marketplace and buying an existing Tommy's Express that already has its own client base, has a couple thousand members, monthly subscribers already signed up. And that's primarily, the value there is primarily if you want to take down a geographic area. You get some protected geographic area. And I'll give you an example. We bought one of those, a very well performing Tommy's Express in San Antonio. But the reason we bought it, and of course it was stabilized, it was very well run, it was one of the top 10 in the Tommy's organization. We bought it, but we bought it strategically, knowing that we wanted to control the San Antonio market. And so, while we are open to the idea, and this is very strategic, but we're open to the idea of buying a stabilized a stabilized Tommy's Express, or maybe even a small portfolio, we feel like we can deliver, in general terms, we feel like we can deliver greater value when we build, because we can build that same product for $7.5 to $8 million instead of buying it for 10, 12, 14.
And I would assume that you would probably get some better tax benefits when you're outlaying all of the capital and you can, write off those things and, set your depreciation schedules, as opposed to kind of coming in and, you get what you get. If a cost seg on a building and an operation comes back, okay, great. You can only, you can depreciate X versus Y. When you're building something, you can kind of control those costs and factors. And again, one, do it for cheaper, and two, then maybe get some additional tax benefits. Or are they kind of a wash when you look at it from different perspectives? Is, basically the capital outlay is really the price tag's the main difference. The tax benefits are roughly the same and scale accordingly.
Yeah, pretty much. I mean, either way, you're going to have an asset that you're going to be, paying, a premium for. And then, of course, if you buy a stabilized asset, there's always a portion of that, cost that could go to goodwill, which is not depreciatable. But, of course, most of that asset, most of that cost is going to go into the buildings, equipment, all that. So either way, you're going to get an aggressive tax impact. But, we've done it both ways, and both ways can work very well.
Now, when it comes to the development of these things, one thing that I just kind of had earmarked here, especially here in Florida, is do you have a lot of regulatory issues when it comes to developing these? I know anytime you're dealing with, things that produce a lot of, runoff, whether they're utilizing chemicals, things like that, do you run into a lot of issues? Is it state by state? Is it locality by locality of, things like water usage, sewer, chemicals, things like that? Do you run into a lot of issues, or is it not as bad as some people might think? Because I know here, you hear about things like laundromats, things like that, that they've been around for like 30 years, and all of a sudden you got, groundwater pollution somewhere. So do you run into a lot of stuff like that, or have there been kind of, workflows that have been built into where, there's the equipment now to where it kind of drops in and kind of mitigates any of those issues?
So there's definitely regulatory issues, regulatory stuff that we got to look at, but our system is set up to where, the water filtration system and the reclaiming the water that we're using and all that really helps us in many of those cases. Just recently we're getting ready to build a Tommy's Express car wash where it's, the township where we're building it in hasn't allowed a car wash in that township for the last 20 years, and they say they won't again after us. They won't allow another one in there, behind us, which, is great because it provides you a real moat in that market.
Yeah.
But one of the reasons that we're, that they allowed us to come into their township was because of our equipment and how we reclaimed the water and how we left a, very minimal footprint. And so regulatory, yeah, I mean, that's stuff we got to work through, but we got the kind of equipment, systems, and processes in place that work for us in those kind of situations and make it a lot easier for us.
That's great. Yeah, I kind of assumed as much. It's just, living here in Florida, we have the most coastline of any state in the nation, which is a fun Jeopardy fact. But, it's just something that you hear about all the time, and especially with so many car washes popping up. I would have, again, I kind of assumed as much that, y'all have gotten this down to as much of a science as possible, so that way it's not left up to guesswork. You can kind of come to a, when you go for all the permitting and everything, say, hey, look, this is what we're doing. Here's how it works, instead of being like, well, we're something new and exciting, but that's, again, kind of what I figured. Now, when it comes to the actual operations of these things, it's kind of interesting. People think back to car washes and, the movies where it's, a bunch of people out front washing these cars off, drying them. These types of car washes that we're talking about are much more kind of stripped down operations, a much more self-service model where you don't have as much overhead as far as, employees and things like that. It's kind of tell us about a little bit of the operations of these things, and again, why investing in something like this can be, more beneficial than just buying a business like a like a corner store or a gas station or something. It has very low employment overhead, correct?
Well, and that was never more important than the last 3 years. I mean, look, when you think about a business and where most of the problems come from, where is it? It's in, people. People,
Yep.
most problems have hair on top, I mean, it's the people. And so, look, I've got a great team here. I love our people. And they're all stars. And I wouldn't want to do without any one of them. But I will tell you, when you're dealing with, lots of employees, wage-based employees, lower income employees, a lot of time, those are where most of your problems come from. We can, on a busy Saturday, we can crank our volume up to 200 to 300 cars per hour with two to three employees on site. So we can do massive volume with just a few people on site, and that too, as those issues, those employees, any business owner over the last 3 years will tell you what's one of the top challenges that they've had over the last 3 years period, and that is getting quality employees, getting employees, period. And so when you can run volume like that with a minimal amount of employees on site, staff on site, that's a big deal. And that's the other thing that investors are starting to realize, and institutions are starting to realize, the kind of volume that you can crank out of one of these locations with a minimal amount of employees on site.
Yeah, and I think that's, again, one of the nice things about investing in things that have low employment overhead. That's why, commercial real estate is attractive. You can have so many different, income producing, different little cells, and you need, 3 or 4 people in a management company to manage, 100 doors. It's that low employment overhead that makes things attractive when it comes to cash flowing assets. And it's pretty interesting to see that model kind of be transcribed into things that, can be automated pretty well, such as a car wash, which is, again, one of the reasons why I think it's interesting to talk about this is that it's investing in a business, but it's a very automated business. It has low overhead, but it has high volume. So, again, it's pretty interesting. Now, there's like 3 things I mainly want to cover before we, wrap this up. We're kind of at the halfway mark. One being the interesting thing you said about being able to depreciate everything as like equipment as well as the building. 2, kind of the outside struggles you have with institutions coming in, and 3 being kind of the nature of how these things are structured. So I'll kind of let you take a pick from one of those 3 of which avenue we want to go down first for the second half of this interview.
Yeah, so we'll talk about institution. I'm happy to talk about any of the 3, but we'll talk about institutional demand. I mean, we've seen institutions come in, and the few portfolios of well-run tunnel washes that are available, I mean, we're talking like 2 to 3 have traded in the last couple of years, maybe 4 have traded in the last couple of years, and we're seeing multiples, 20 times EBITDA. Yeah, I mean, the margins that they're paying for a well-run large portfolio, special emphasis on large, they don't want to buy one car wash. They don't want to buy 1, 2, 3, 4 car. They want to stroke 9-figure checks. It's not worth their time. And so, when we've seen these large portfolios come up and are available, that we've seen institutions come in and snatch them up at, more than 20 times EBITDA, and that's been very interesting to watch. So we're really building this car wash business with an exit in mind, although we want to build the business to where, it's one of those businesses where you'd hate to sell it, but you'd be crazy not to. So that's sort of where we're headed.
Yeah, that's absolutely wild that someone would come in, especially the institutional side, and ever pay 20x EBITDA for something. I guess that's good, but it's also extremely bullish. I mean, I don't think I've heard anyone be as bullish on anything else, especially on something where it's not necessarily like a standalone business. I mean, you could say, hey, this, John's Tavern, it has this special sauce, and it's, that their specific business, this one standalone business, is worth 20x of that. But when you're talking about an industry in general, now when you're talking about these institutional investors coming in, now again, you said they're not necessarily looking for the 1, 2, 3 locations, or maybe going into the emerging. They're not necessarily in the development play. They're in the acquisition of kind of like a small tranche of these, like, you mentioned 9-figure checks. So is that when like a block of 6 of them come up, 7, 10? Like, what's kind of the amount of like a portfolio that would come up for the institutions to really be interested? And are they interested at all in the development side of things like you're doing?
Well, so there's a couple things there that I'll address, and one of our advantages from an institutional perspective, one of our advantages, and it's kind of the big moat around what we're doing, is normally when you go into a market and you get a piece of real estate and you go through the due diligence process and you go through the entitlement process and you go through the build process, you're talking a 2-year window. Private equity, institutional capital isn't that patient. They don't want to wait 2 years. They want to buy a stabilized portfolio or a stabilized asset of some kind. And then to your second point, about the margins. So, we've seen these smaller portfolios sell for, let's say 2, 3, 4 car washes sell for, maybe 8 to 10 times EBITDA. And then maybe, 6 to maybe 8 to 15 trade for, 10 to 12, maybe 13, 14 times, maybe 10 to 12 times EBITDA. We've seen the larger portfolios that really catches the attention of these bigger institutions. Those are the ones that we've seen trade for 20x.
Okay. Yeah, it's but again, so they're that's kind of, good in a sense that, most of the time when we think of institutions getting involved, especially what we've seen in like the commercial, the multifamily space, the industrial development space, they are, really kind of taking it down full stack. They've gotten into some of the development, they've gotten into some of the more stabilized markets. But, with this, you're basically saying that they're only looking at, the stabilized portfolios, if you will. If you have, the 9, maybe let's call it like 10 plus, locations or, storefronts, that's what they're kind of looking at. Everything else, as far as kind of like the development side, is kind of rife for the individual and the smaller, mom and pop investor, or the acquisition and the reposition of, the individual mom and pops. Does that kind of ring true with the market in general right now?
Yeah, and that's sort of where the opportunity comes in for investors like us. I talked about that moat that kind of protects us. It gives us that kind of protection because private equity and institutional money doesn't have the patience to sit there for 2 years and wait till you get to some positive income. So that creates a great opportunity for investors like us to go out and sort of burn off that 2-year window and really get the car washes out of the ground and get them in operation and get them stabilized, because they're not so much, we've seen this in the self-storage space as well. They're not into the value add strategies. They're not into buying from a mom and pop operator, bringing up the efficiencies, adding expansion project, whatever. They want to buy a stabilized portfolio of something and just take over from there.
Yeah, and that's really great. The fact that opportunity still exists, and I would imagine, it seems like it would probably stick around, because especially with assets that are kind of as, this is kind of an interesting one, because it has, the commercial real estate aspect, but it also has the, just the straight business play aspect of something. So, it kind of is, not as maybe as much of a marriage, kind of like self-storage is, between like apartment buildings and business operations. It's definitely more business forward, I would say, on this, but it definitely is one of those things where it, has a barrier to entry that keeps the institutional people, at bay, to allow enough of a market for, everyone else to play in the sand, if you will. Now, when it comes to, the actual structure of how, again, institutional investments be what they are, but, let's say you have an investor coming in that wants to get involved in this. Are these things mainly structured, as, like syndications? Are these things like LLCs where people buy into chunks? What is the kind of the investment structure of these things look like from the outside investor? And, what kind of, again, we can kind of fold that into what particular tax benefits might be offered, and if there's different structures out there for these things.
Sure.
As well.
Yeah, no, we have a fund open And typically when we open a fund, we'll keep it open and have 6 to 8, 6 to 9 car washes per fund. And accredited investors can come in and invest in that fund and take ownership in those 6 to 9 car washes that are in that fund, which gives them some diversification across, could be a couple different markets. And then, every dollar that gets invested from our limited partners, our investors, that depreciation flows back to that basis. So investors coming into the fund, invest in the fund, they get the full impact of that depreciation. So it turns into, not only a cash flow play for an investor, but it turns into also a tax efficiency play for an investor.
Absolutely. Now, do you run these as kind of evergreen funds, or do you have like a set criteria when you set up the new pooled investment fund for saying, hey, we're going out in a particular, like how well defined do you do these things, or do you kind of keep them open ended? Because I've seen people, I've seen the pooled investment fund model start to get a lot of traction, especially with the velocity of different assets in the commercial space. So tell us a little bit about kind of your strategy, at least when setting up these funds. What are y'all doing, or is it kind of a general consensus among the industry?
Yeah, so it's not evergreen. So we close down when we get to we got 100 investor limit to any specific fund. So when we get to that 100 investor limit, that's why there's a range of between 6 and 9 car washes, because when we get to that investor limit, then we close down the fund, we'll open up another one, assuming there's supply. There's always that supply demand balance, where you got more car washes than money, or you got more money than car washes. So we play that balance. But look, we're aggressively on the path to build 80 to 100 car washes, and so there's going to be plenty of opportunity for investors to come in and team up with us, have the potential to make a really nice return. I mean, we're looking, we show on our investment summary, and I'm happy to share this with you if you'd like to see it, but we share on our investment summary, we share 3 different scenarios of what a potential return could look like to an investor. And, of course, the more aggressive one is, more than a 3x multiple on their invested capital. And one of the interesting things to remember on this is that even our most aggressive kind of pro forma is less aggressive than what we've seen happen over the last couple of months in the market today. Even with all the challenges that we've seen in the market, higher interest rates and, kind of investors kind of pulling back, lenders, debt's harder to get, whatever. We've seen those kind of margins in today's market. And so, we're seeing that, and our pro forma is less aggressive. Our most aggressive pro forma is less aggressive than what we're seeing in the market today.
Yeah, that's awesome. And that, again, coupled with a good tax strategy is always, key in that. And the last thing that I kind of wanted to get into is that, I'm a little bit of a tax nerd, and it comes out in this podcast, but you mentioned kind of an interesting aspect of these car washes being able to basically depreciate them as equipment, and not just a dwelling or a piece of real estate. Get into some of the interesting things that offer and I say special very very air quotey with that, but again, when someone says something like that to me, it really kind of piques my interest of saying, okay, that's really cool, this kind of makes sense. Get into some of like the special use case stuff, especially again, like being able to depreciate something in a different manner than people are kind of used to when it comes to commercial real estate.
Yeah, so a couple things. One, let's use the analogy of a multifamily apartment building as a comparison to a car wash. Okay, so multifamily apartment buildings, you get to depreciate that building in 27 and a half years. Okay, but if you pay for and have a licensed professional cost seg study company run out and do a cost seg study for you, they'll break out components of that building and give you a bunch of different lifespans for different things in that building. So let's say a water heater, you might be able to take that in year 1, take depreciation in that in year 1, write that whole thing off in year 1, whereas flooring might be 5 years, whereas paint and sidewalks and whatever. It could be 10, 15 years, whatever that is. And then they'll lump all that together, and they'll allow you to pool a lot of your depreciation that would have gone on over that 27 and a half years, and they'll allow you to pool a lot of that forward into the, and use it in the first, 1 to 5 years. In the car wash space is very different in that equipment, you can write all of the equipment off in year one. So 100% bonus depreciation, 80% of it happens in year one. The difference is not only can you do that on the equipment, just like you could in your water heater. Remember the water heater in the apartment building? Well, you can do that on all of the equipment inside the building. Plus, you can throw the building in that whole package yet. So now you get 100% bonus depreciation, 80% in year one on the building and the equipment. So I don't know what that's about. I don't know if the car wash industry just had really good lobbyists or what happened there, but for some reason, a car wash, you can take the building and throw it in with the equipment and get that 100% bonus depreciation.
And I mean, it would kind of, I see where they're kind of coming from. I mean, the building is the equipment, if you will, especially for, I think you said you called it a tunnel car wash, right?
Yeah.
You drive through the thing.
Well, you're right, and it's single purpose, and you can't retrofit a car wash and turn it into retail or offices or something like that. So I mean, I guess you're kind of right. It is kind of a piece of the equipment, really.
Yeah, I mean, even you can have an office in there, but it's going to be, a filing cabinet, and it's probably going to share rooms with, pumps for, pressure washers and chemical stuff. So, that's definitely really interesting. Does that offer any type of, you get to, while it is awesome that you get to take all of this, kind of in year one, what type of carry forwards does this offer? I mean, is it basically the standard runoffs of when you get to actually utilize these write-offs? I would think, especially if you're doing something that's development based, maybe having all of that so front loaded wouldn't be as ideal. Or kind of what's, again, being able to take that as an equipment depreciation is awesome. Instead of having the 27 year and then having cost seg breakout stuff individually, being able to do first year 80% is awesome. But are there any kind of too much of a good thing type scenario that happens with all of that depreciation that gets to be passed forward in this specific use case?
So I don't think there is a bad way to use depreciation. There's a more aggressive and a more conservative way to use it. And to me, more aggressive appreciation front-loaded on the front end that I can use today is better than if it's stretched out over 5, 10, 15 years. Because I can use it. As long as you're in growth mode, you want that depreciation, and me personally, I want that depreciation as early as I can get it. I can use it this year. And so, but if that's, if an investor is coming to us saying, well, hey, I work in a dental office, I'm a W-2 guy, I have no other passive income, that's a total different story for that investor. He or she still gets to use that depreciation, but you may have to, save that for future years. He may not be able to use it all in year one, which isn't bad. It just sits there in your depreciation bucket until you can use it in year 2, year 3, year 4, and it does have the typical runoff that you would see. You get 80% in year one, and then you get the rest of it, over the next 4 years after that.
Yeah, and also you can only write off, investment depreciation and losses can only offset $6,000 of ordinary income per year for your W-2 stuff. So basically it's kind of nil for what you get to capture on that side. I want to say it's roughly something like that. Do you know the number on that?
Well, it's primarily going to be primarily going to knock out the tax liability on your passive income, because this is a passive asset. We manage the asset, we work the asset, and an investor coming in and investing with us, this is going to be passive for them. So if they got lots of other passive income, or they got a capital gains, liquidity event, or appreciation recapture, or something like that, they'll be able to use a large chunk of this in year one. But if that's not their case, and I use the example of a W-2 employee could be making, $200,000, $300,000, $500,000 a year, this depreciation, he won't be able to use that to offset the W-2, the tax liability on his W-2 wages, but then he'll just sit there in his bucket and wipe out the tax liability that's coming from the cash flow from his car wash investment or some other passive income.
Yeah, no, I think we're talking the same thing. Yeah, no, great. This has been, really kind of an interesting dive into this. Now, has there been anything that we haven't really touched on that you think is a benefit for people to know? And again, I'm assuming that, we talked about how you structure your investments as pooled investment funds with, kind of a cap and a scope, not necessarily an evergreen. I'm sure there's people that do evergreen sides of these. I'm sure there's people that do like individual syndications for, individual locations or blocks of these to take down kind of a portfolio of them. So again, I'm assuming I'm correct in talking. There's kind of a typical range of the normal commercial real estate, again, very loosely, investment structures for investing in these kind of things, correct?
Yeah, so I mean it's set up like a typical fund. We have a fund for ATMs, we have a fund for self storage, and we have a fund for car washes. So it's set up like a typical fund, and it we of course there's a process. An investor comes in, we gotta get third-party verification that they're accredited. After that, they look at a set of docs, that's prepared by our legal team, and they'll come in. There's a process, but we make it pretty simple for an investor.
Yeah, no, I'm assuming so. It's just more getting at the just in a broader sense of people kind of looking at this. There's a lot of different ways to flesh this out, and most of them are kind of based in the traditional what they're used to when it comes to investing in commercial real estate. You can buy an individual one, you can invest into a syndication, a pooled investment fund. The options of like kind of what is out there to do this are kind of what they're used to, even although it may be a different asset class in a sense, because it's kind of that hybrid, business equipment. Like it's kind of like the mix of like having a apartment complex versus, an ATM. It's like functional equipment that provides a service and also a piece of real estate that is, running a business. So that's why I kind of find these things interesting. And also anytime I see a lot of new development in any industry, that means that there's money behind it. That means that there's money to be made in it. So again, while people might say, oh, we don't need any more car washes, it's like, well, look behind this. Why is this happening? That's, maybe you don't want to see them, but I guarantee you, seeing, multiples in your bank account might, change your tune if you're on the investment side of this thing, seeing these things pop up everywhere.
Well, and you're right, and they are popping up all over the place, but you're going to see, the wave of the future in the car wash space are in these sort of semi-automated tunnel car washes with the technology and all that in them. Of course, today you've got the little single or triple bay car wash attached to a gas station, or semi-automated, just old, outdated, for the most part, outdated car washes. Those are, with these new, well-run tunnel car washes with the automation, they're going to eat their lunch. So the wave of the future is these new car washes. So even though a town may have 3 car washes in it, you're going to have one dominant player in that small town, and whoever comes up with that best case version of that car wash that people like, that's going to be the winner.
Fantastic. Well, Dave, I think that's kind of a great place to end it off. If people want to get in touch with you or learn more about kind of the offerings that you have, or learn more about any of the, great and interesting things about car washes, how can they get in touch with you?
Yeah, so our website is therealassetinvestor.com, and my team, you can reach my team at info@therealassetinvestor.com.
Alrighty, Dave. Well, thanks again for being on with us today. My name is Alex Perny. This has been the Alternative Investing Advantage podcast, and thank you for joining.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.